This is the Chris Berry Show. Expert information on wealth, estate, and tax planning for the second half of life. Information that you can understand. Here's your host, Chris Berry.
Hey everyone, this is Chris Berry with the Chris Berry Show, and today we're going to start with a positive focus, just like we do every time we do the show. And on the rest of the show, what we're going to talk about is retirement income planning and a approach looking at different time horizons. Because I think we can't necessarily control what the market's going to do. It's going to go up and down. But there are certain things we can control, and we can look at divvying up our assets into different buckets to create income streams. And so we'll talk about that. But first, I want to start with a positive focus, something positive that happened over the previous week or so. And my positive focus this week is that I completed the rough draft of my second book that I've written. My first book being The Caregiver's Legal Guide, which really mapped out a strategy for long-term care and looking at trusts as a way to protect against long-term care costs. And also, if you have a loved one who needs care now, kind of last-minute strategies utilizing long-term care insurance or Medicaid or veterans benefits, and how to find the best care possible. My next book, it's all about building that retirement and legacy plan, building a retirement and legacy blueprint, mapping out what your retirement's going to look like, taking into account the 5 key areas of income planning, investment planning, tax planning, healthcare planning, legacy planning, not just for your retirement, but also what you're leaving to the next generation. So it's really a great guide for overall planning. So my positive focus is that I completed the rough draft, sent it over to the editor, and waiting to get that back. So it's pretty exciting. This is my second book. My first book, I think I completed it in 2014 or 2015. And if I don't know if you've ever written a book, but it's a long process. There's a lot that goes into it. So pretty excited to have my second one kind of off to the editor. I'm sure it'll come back and we'll have some changes and stuff, but I'm looking forward to having that published by the end of the year. That's one of my goals for this year. Now, today, what we're going to do is we're going to talk about a piece of that puzzle. So if you look at creating a retirement and legacy blueprint, you break it into those 5 areas of income planning, investment planning, tax planning, healthcare planning, legacy planning. Then looking at income planning as one of the foundations. And really, I think there's 2 really key ingredients that I view as really the foundation of moving into retirement and beyond. And those 2 pieces to the foundation are creating the legal entity, the legal structure. That's that estate plan, the will, the trust, things like that. And then the second piece of it, and this is really what gives people a lot of peace of mind as it relates to moving into retirement, is creating that income plan. Now that I'm retired, how are we going to look at replacing those paychecks, right? Because you're going to have certain expenses. And we need to figure out how much income do you need per month or how much income do you need for the year. And for a lot of my clients, while they're working and they're in this accumulation phase in life, they didn't think about using the B word being a budget, right? They just had money coming in, they covered their expenses, they saved a little bit or saved a lot, and they didn't really have to worry about kind of expenses or a budget. And then as you move into retirement, now, when we're putting together a plan, one of the first questions we ask is, okay, well, how much money do you think you need versus how much money do you think you want? And there might be a difference there. But that's the starting point. So that's really what we're going to talk about today is how to create an income plan in retirement. And more specifically, one of the things that we do is we need to understand that there's a mindset shift of now we're moving into a different phase of life where initially it was all about accumulation. So while you're working, it's all about saving as much money as possible, banking as much money as possible. And there are certain strategies about where do you save it? Do you save it all in traditional 401ks, pre-tax accounts? Do you save it in post-tax accounts? Do you save it in tax-free accounts? And there's a lot of questions and things to think about where you're accumulating wealth, especially as I'm sitting down with a lot of retirees and all their money is sitting in these pre-tax accounts. And now they're looking at, oh my God, I have a huge tax bill. And this retirement tax time bomb is about to blow up in my face as I have to start taking out RMDs and stuff. So if you're accumulating wealth, or if you have children that are accumulating wealth, make sure that they understand that maybe all the money shouldn't be saved in those pre-tax accounts, 401ks, IRAs. Maybe look at diversifying kind of the tax buckets of where we're saving the money. But again, that's not what we're really talking about today. Today, we're talking about moving from that accumulation stage where we're saving money to retirement, where we call this the preservation and distribution stage. So all of those assets that you've worked so hard to accumulate during your lifetime, now we need to come up with a strategy of how do we use those assets plus whatever fixed income sources you have in retirement to cover your income and expenses throughout the rest of your retirement. And this is really what people are concerned about when we're talking about, can I retire? Will my money last as long as I do, or you do? And it's all about creating that income plan and utilizing those assets not for just growth and accumulation, but now adding in the fact that now we need to turn those assets somehow into income to cover any type of income gaps that we have. And so I collaborated with a colleague of mine a few years ago to co-author and write the introduction to a book called The Bucket Plan, which I think is a very innovative, not necessarily unique, but a good way to think about transitioning your assets from this accumulation world to now a preservation and distribution, where now we're not looking at trying to maximize returns. It's all about maximizing your assets to make sure they last as long as you do, and taking a look at things that we can control. And so a big part of this is understanding time horizons. And this is very important as we're moving into retirement, is to understand different time horizons. And so breaking up your assets and everything you work so hard for into different buckets based on when we think we're going to utilize that money or need that money. And then based on that, that's going to give us instruction on how those investments should be put together. Because typically when you're accumulating wealth, you might have a couple different accounts, but it's all geared towards just growth. You want to grow as much as possible. And then as you get near retirement, maybe you get more conservative. And I see a lot of people in these kind of target funds where, all right, it's my investments are at Fidelity and it's a target fund 2025 or 2030 that automatically, as I get closer to retirement, it shifts more of the equities to bonds, right? And that's a whole nother discussion, getting into investment planning and what's wrong with those target funds. A big thing is all the expenses hidden inside of those. The expense ratios on those are crazy. And the second thing, not to get off track, is a lot of times they're shifting to bonds, which right now, if you look at your mortgage rates and the interest rate is super low, well, guess what? That is also affecting your bonds. So maybe that bond portfolio that you're shifting towards as you get near retirement isn't the best route to go. But that's an aside. So the idea is that as we get near retirement, you might have everything kind of bucketed in one bucket of just growth and accumulation. Well, now as we move into retirement, all of a sudden those paychecks go away, those wages go away. Now we're going to have to start structuring our assets potentially to be able to draw on. And now we face some different risks. One of those big risks that I'll get into is what's called sequence of return risk. And so there's a process of figuring out how should we structure this income plan. And so, like I stated, I wrote the foreword along with someone else who's relatively famous in the investment world, Ed Slott. So Ed Slott, myself wrote the foreword. My colleague Jason Smith wrote this book called The Bucket Plan. And my preface that I wrote a couple of years ago, that's part of the bucket plan. So we have some of these books that are available. We'd love to send you a copy. While we still have them available at our office, all you have to do is give us a call and leave your name and email and address, and we'll mail you out a copy. Phone number is 844-885-4200. And again, what we'll do is we'll send you a free copy of the bucket plan that talks about protecting and growing your assets for worry-free retirement, where we talk about creating a plan that'll free you from worry, stress, and confusion as you move into retirement. And really what it is talking about understanding that we're going from an accumulation phase in our life to now distribution and preservation. And these assets that we've earmarked completely for growth and accumulation, now we need to structure them in such a way that, sure, they can offer us some growth, but also now we need to cover our income. Okay, and that's what we cover in the bucket plan. So if you do want a copy of the book, just give our office a call at 844-885-4200. Make sure to leave your name, email, address, and address to mail out the book, and we'll put it in the mail for you, as long as we still have copies left at our office. When I worked with Jason and Ed Slott to put together this book, I had a certain number that they shipped to my office. So I'll have my team just mail those out to you. But again, you have to let us know that you want a copy. You have to raise your hand. And so in the book, I'll just tell you a couple of things that we talk about before we get into income planning in the next couple segments. But first, we talk about some of the big risks that are faced in retirement. And we'll get into this on the show today, but market risk and interest rate risk, and a big one is sequence return risk. And then we'll talk about, in the book, we talk about the idea of the bucket plan of looking at time horizons for how we should structure our investments, and how we should have maybe a now bucket that will cover our next year, a soon bucket, and then also a later bucket of money that's geared towards growth and potentially legacy. And we'll talk more about that. And then also in the book, we talk about behavioral finance and some of the worst mistakes investors make on their own, and why it's important to work with an advisor on how to avoid a lot of those mistakes. A big one is trying to get into market timing. We saw this this past year with a lot of the GameStop and everyone moving to the Robinhood investing and in the day trading, where for every one story of someone walking away with plus 400,000 on their investments, there are a lot of people that lost a lot of money trying to time the market. And then in the book, we talk about some of the basics of financial planning, of creating a asset sheet, understanding what our assets are, understanding how much income we need in retirement and whether we have an income gap, and then talking about volatility and how much risk we are willing to take on in our different buckets, whether it's that soon bucket or that later bucket. Because again, based on time horizons, potentially we should be looking at investing in different amounts of risk depending on when we think we might need to access those funds. Because we can't necessarily control what the market's going to do on a daily basis. But what we can control is we can control things like time horizons. We can control when we're going to access certain funds and when and how we're going to access that. So it's things like, should we be drawing down our IRA first? Or should we be drawing down our Roth IRA first? Or should we be drawing down our brokerage account? Or if we have a IUL or LIRP, which is cash value life insurance or life insurance retirement plan, should we be drawing that down, right? So it's allocating and understanding that we have these different assets and investments that we worked hard to accumulate during our life. And then it's all about figuring out, how do we preserve those, and then what is our distribution plan for retirement? So what order do we start drawing on those assets in retirement to put us in the best position possible to make sure that our money lasts as long as we do, and then B, if legacy planning is important, how do we make sure that we can leave as much to the next generation as efficiently and effectively as possible? So if you do want us to send you a copy of the Bucket Plan book, where we talk about protecting and growing your assets for a worry-free retirement. And again, I wrote the preface for this. The foreword was written by Ed Slott, who's well-known in the tax world, and this was written by a colleague of mine, Jason Smith. Then we'll go ahead and send you a free copy as long as we still have copies at our office. But all you have to do is give our office a call at 844-885-4200 and leave us your name, address, email address, and phone number, and then we'll make sure to mail out a copy of the book at no cost to you. So again, all you have to do is raise your hand and say you want a free copy of the book, and then we'll go ahead and mail that out to you. And also another resource, if you want to learn more about our approach, would be to join us every Wednesday at 1 o'clock. So every Wednesday at 1 o'clock, we have a weekly wisdom webinar. And you can find out more information about this at our website, castlewealthlegal.com, where I have people submit questions ahead of time or ask questions live on the webinar. And really, it's almost like open office hours, where all I do is I sit there and ask questions that have been submitted ahead of time, or ask questions or clarify answers live via that webinar. And you can go ahead and register. We do them every Wednesday at 1 o'clock. And then also they're recorded. So if you have questions on income planning, investment planning, tax planning, healthcare planning, long-term care costs, legacy planning, estate planning, that's really the best way to just build up your knowledge is by attending one of our weekly wisdom webinars. And all you have to do is go to castlewealthlegal.com. Right on that front page, there's going to be information to register for one of our webinars. And stick with us as we continue this conversation. We'll get into income planning for retirement.
Hi, we're Madison and Ryan Berry.
Our dad is Chris Berry from the Castle Wealth Group.
The Castle Wealth Group used to be the elder care firm, but Dad wanted the company to be broader in its scope of services.
To not only protect and preserve assets, but to help people grow their assets to prepare for retirement.
As a certified elder law attorney and fiduciary financial advisor, our dad and his team at Castle Wealth Group can help you with lots of important things.
To tell you more, here's our dad, Chris Berry.
Thanks, Maddie and Ryan. Here at the Castle Wealth Group, we can help you put together an estate plan to avoid probate, work with you on a tax plan to keep more money for your family and less for Uncle Sam, and protect you against the devastating cost of long-term care. Our team is here for your family. I invite you to learn more about the Castle Wealth Group at our next free workshop, where you will learn the 3 steps to create a legal, financial, and tax plan for the second half of life. Call us today to register at 844-885-4200.
The Castle Wealth Group, formerly the elder care firm.
Learn more at thecastlewealthgroup.com today.
All right, so we're talking about income planning, and income planning fits into one of the 5 key areas of a retirement legacy blueprint. That being income planning, investment planning, tax planning, healthcare planning, and legacy planning. So income, investments, tax, healthcare, and legacy. All 5 of those areas need to be addressed as you're moving into retirement to plan for your retirement, and then also efficiently and effectively pass whatever it is to the next generation or to friends or family versus leaving it to probate courts, etc., state of Michigan, wherever else, right? So today we're focusing on income planning, and we have a great resource that talks about organizing your assets so that now they're not so much geared towards accumulation like they were while you're working, but now we need to organize everything you work so hard for to preserve it and also to help create an income plan in retirement. And that's where we have the book called The Bucket Plan, Protecting and Growing Your Assets for Worry-Free Retirement. Foreword was written by Ed Slott. I actually worked with Jason Smith, who wrote the book, and I wrote the preface for the book. And we have some extra copies in our office All you have to do is raise your hand, give us a call, and say you want a copy, and we'll go ahead and mail a copy out to you. Just give us a call at 844-885-4200, or feel free to go to our website, castlewealthlegal.com. Just put in your information. We can mail a copy out, as long as we still have copies available. We do have a box left, so would like to get those out to you. But yeah, so we're talking about income planning, which really is one of the foundations. And I think for a lot of people, one of the things that once we create that income plan for them, they have so much peace of mind. They have so much, you can just see the stress evaporate from their face because we've mapped out a plan of how they're going to move into retirement and have all of their expenses covered in retirement. It's one of those epic questions of, do I have enough to retire, right? You might have seen some of the commercials by some of the big box financial places like, what's your number, and this type of thing. Well, it really depends. It really depends on creating an income plan. It's not about like, I need to save to $1 million. It's all about developing that income plan. And so there's different things that go into that income plan when we're putting that together. We look at Social Security. When are you going to time Social Security? Social Security maximization, especially with married couples, there's so many different options. Should the higher earner take Social Security early? Should they take it later? What happens if one spouse passes away? These are all questions that we answer as we go through our process. Second, looking at an income and expense analysis, right? And this is one of the foundations of creating that income plan, and we talk about this in the book, is figuring out what is that income gap if we have one. And what we're talking about here is looking at your fixed sources of income, which might be Social Security, might be pension. Pensions are starting to go away, versus your expenses, right? And so in the past, we always had this three-legged stool of income. It would be Social Security, pension, and then you could draw on your assets. Well, here's the thing. Your pensions are going away, so there goes one of the legs of the stool. A lot of people are uncertain about Social Security, so let's cut that one in half. Now we have our assets. So instead of having a three-legged stool, we have a 1.5-leg stool, right? And so how do we kind of balance that moving into retirement, right? And so we start with that income gap where we look at, okay, how much income do we have coming in versus what are our monthly expenses? And then based on that, we might have an income gap that we now need to figure, right? So let's say we have a combined Social Security and pension of $3,000 a month, but our expenses are $5,000 a month, right? So that means that we have an income gap of $2,000 a month. Well, how do we draw on our assets in such a way to cover that? And that gets into some of the risks that we have moving into retirement, like sequence of return risks, because now we're moving into a completely different world where initially it was all about accumulation. Well, once we have to start drawing on our assets, then we need to think about preserving it because we don't want to draw on assets that are going down because of market volatility, right? That's where we get into one of the big risks, which is called sequence of return risk. So calculating that income gap, so that income and expense analysis is a key ingredient in income planning. Next, inflation planning, right? So the cost of bread is always going up, right? So you see this as it relates to Social Security. Every year you get some type of bump in terms of your funds, unless it's zero. But on average, your Social Security goes up about 2.5%. So that's to take into account cost of living and inflation, right? And so I've sat down with people that have a ton of money sitting in cash, like $500,000 sometimes sitting in cash. Well, that's great. That money is not going anywhere. It's safe. You're not going to lose it to the market. But understand with inflation, you're actually losing out. You're losing to inflation. So what can we do to still give you safety, but build in protection against inflation, right? We shouldn't have all of our life savings just sitting in a checking or savings account because we're missing out on the growth to at least keep up with inflation. And then next is a key ingredient. And this is something that a lot of couples overlook. And that's taking care of that surviving spouse, okay? So what we're talking about here is making sure that when one spouse passes away, that surviving spouse is still in a good position. And I'm not just talking about like adding extra life insurance or anything like that, but just think about it. Think about all the things that happen when one spouse passes away. One of the biggest things, and this is something that Ed Slott, who's known as kind of America's CPA, really well known in terms of retirement income tax planning from a tax perspective. He calls this the widow's penalty, because when one spouse passes away, you go from a married filing jointly tax bracket to now a single filing. And now that surviving spouse probably needs the same amount of income, but now they're going to have to pay almost double in terms of taxes potentially, because they went from a married filing jointly tax bracket to now a single filing, right? And then also what happens when one spouse's Social Security disappears? Or depending on how you took that pension, what happens when that pension disappears? Now that surviving spouse might have the same level of expenses, but now the Social Security is cut in half maybe, the pension has went away, and now taxes have went up. These are all things to think about that when I bring these up with married couples, a lot of them, they haven't put a ton of thought into it. They just think that, well, if one spouse passes away, everything goes to the surviving spouse, they'll be taken care of. Yeah, the assets might, but what about that income plan for that surviving spouse? What about that tax plan for that surviving spouse? So there's certain things to think about when you're a married couple, especially from a tax perspective. Like if you're listening to this and you're sitting there and you have pre-tax accounts like IRAs, 401ks, then we need to look at a tax plan, not just because we know taxes are going up, but we need to look at it from an income plan for that surviving spouse to make sure that that surviving spouse isn't going to be killed having to pay taxes on the same amount of income that you needed while you're a married couple. So spousal planning is one of those things that we see overlooked a lot of times when people are kind of handling this themselves or doing it themselves. And we bring this up, and trust me, I've sat in so many meetings, and I'll have a husband and wife, and not to stereotype, a lot of times it's the husband that kind of manages the assets. Maybe the husband's an engineer. But then I bring this up, and the surviving spouse, their eyes get like wide. They're like, yeah, I need to make sure I'm taken care of, right? So understand that's something to think about as well in terms of income planning. And then the last thing in terms of income planning that we talk about when we're just focusing on the income planning piece, again, the income planning is just one piece of the puzzle. But the last piece of income planning is to look at longevity. And longevity is one of the biggest risks because it reinforces and makes every other risk that much more important. Because the longer you live, the more there's a chance of needing long-term care costs. The longer you live, there's more of a chance we need to make sure your money lasts as long as you do. The longer you live, the more taxes are going to come into play, especially when you talk about required minimum distributions. The longer you live, the more we need to be concerned about market volatility and sequence of return risk. So this is something that I've seen over the last 15 years of doing this. Is initially when we first started, a lot of times people were thinking, all right, we need to make sure this plan lasts to age 75 or 80. Well, guess what? Now I'm sitting down with people and we're making sure this plan lasts to age 100, right? And so it's almost a different mindset. And understand that there's different approaches to that income plan. And this is something we talked about on that Wisdom webinar that we had today. I'm recording this on a Wednesday and we're airing it on a Sunday. But one of the things we talked about on our Wisdom webinar that we just had was the idea of the 60-40 portfolio and the idea that, okay, I'm just going to take out 4% a year and I'm going to be okay. Well, guess what? That 60-40 portfolio, there's plenty of studies to show that that's not the magic bullet that everyone thought it was. A big reason of that is because of bonds and interest rates, right? And especially if we're trying to if we're concerned about longevity and making sure this plan lasts to 100, if there's a better way to do things to make sure that money still gets a good rate of return but still can cover income, guess what? That 60-40 portfolio probably isn't the way to go because that 40% you're putting into bonds right now, bonds are really one of the last things you want to be invested in right now because A, what we found is they're not a great hedge against the volatility of equities, and there's plenty of studies to show that now. The correlation is kind of scary when we thought before that they were like opposite correlation. That's not true anymore, especially in this low interest rate environment. And then B, with interest rates where they're at, like I have a lot of clients, and if you have a mortgage right now or looking to refinance, reach out to us and we can get you in touch with our mortgage expert. But right now, mortgage rates are super low. And so that's a great thing for mortgages where you can refi and get a 2 or 3 or less than 4% mortgage right now. But guess what? That's killed your interest rate on CDs. Your bonds are getting killed. And so that's where a lot of times we're looking at bond alternatives to put together an investment strategy so that this money that you've worked so hard for lasts at least as long as you do. And so this is where your investment strategy kind of goes along with your income plan. Is first, a lot of times we have to identify how are we going to handle your investments from an income standpoint. And this is where we get into the bucket plan of, all right, let's put these different investments that you've worked so hard to accumulate, let's put your nest egg in and divvy it up amongst different buckets based on time horizons. And this is what we talk about in the bucket plan. And if you do want to copy, well, let me talk about the bucket plan, just kind of big picture a little bit. So the idea is that we break things up based on time horizons. And so first, we want to have what we call a now bucket of money. This is money that we think we might need over the next year. And this is going to be made up of a couple different things. And if you have a pen and paper, now's a great time to take some notes if you haven't. So in that now bucket of money, really it's covering our next year's worth of income and expenses. So what should be sitting in that now bucket would be whatever your emergency fund is. And that might be 3 to 6 months worth of expenses. Okay. Then second, it would be whatever big expenses you have coming up throughout the year. So if you're looking at taking a big trip or fixing up the kitchen, or you have to get a new roof, or you have a daughter that has a wedding coming up within the next year, that money should be safe and liquid and sitting in checking savings. You don't want to lose that. You want to get access to it. So that now bucket should be invested in checking, savings, money market. It should be safe and liquid because it's going to cover your emergency fund. It's going to cover any big expenses. And then here's where we get into this income and distribution and preservation plan in the bucket plan. It also should cover whatever your income gap is for the year. So like I talked about, if you have an income of, say, $3,000 a month and your expenses are $5,000 a month, you have a $2,000 a month income gap. Well, we should have that multiplied by 12, so 24,000 should be sitting in checking, savings, and available to cover whatever your income needs are for the year. So your now bucket should be sitting at the bank and should be your emergency fund, any big expenses you have planned for the year, and then whatever your income gap is for the year. Everything else should be really probably out of cash. And the reason for that is that will buy you a year of, if whatever happens, so that buys you a year time horizon. Then the rest of your investment should be invested either in your soon or later bucket, where now we're at least keeping up with inflation. Because guess what? When you invest in just safety and liquidity, investing in that now bucket where the money's sitting at the bank, you're not getting really any growth. In fact, you're falling behind with regards to inflation and cost of living. So that's why we don't want to see a ton of money sitting in cash. It really should be allocated to one of three things. Either your emergency fund, which typically 3 to 6 months worth of expenses, maybe $30,000 to $50,000. Second, any big expenses you have coming up for the year. Okay, are you fixing up the kitchen, going on a big trip if you can travel, getting a new roof, a new septic, whatever it may be. And then third, if you are retired, you may have an income gap. So take a look at what that is monthly, forecast that out for the year, and that should be sitting in checking savings. And that's something we talk about in the book, the Bucket Plan book, which more than happy to send you a copy. Just give our office a call at 844-885-4200. or just go to our website, castlewealthlegal.com, click through, contact us there, and you can request a free copy. And as long as we still have copies available at our office, we'll mail it out to you at no cost.
Hi, Madison and Ryan Berry here from the Castle Wealth Group, formerly the Elder Care Firm.
Our dad is Chris Berry.
He's an attorney and fiduciary financial advisor, which means he helps families plan, protect, and preserve their assets.
The entire team at the Castle Wealth Group can help you with lots of important things. To tell you more, here's our dad, Chris Berry.
Thanks, Maddie and Ryan. Here at the Castle Wealth Group, we can help you put together an estate plan to avoid probate, work with you on a tax plan to keep more money for your family and less for Uncle Sam, and protect you against the devastating cost of long-term care. Our team is here for your family. I invite you to learn more about the Castle Wealth Group at our next free workshop, where you will learn the 3 steps to create a legal, financial, and tax plan for the second half of life. Call us today to register at 844-885-4200, 844-885-4200, or visit us at castlewealthgroup.com.
The Castle Wealth Group, formerly the Elder Care Firm.
Learn more at thecastlewealthgroup.com today.
So we're talking about income planning and how that fits into the retirement and legacy blueprint. And remember, there's 5 key areas we always focus on: income planning, investment planning, tax planning, healthcare planning, and legacy planning. And in terms of income planning, a lot of it is looking at just rethinking or taking another look at how you've invested your assets. And so understand that while you're working, you're in an accumulation phase of your life, but now you've reached the top of the mountain, and we need to figure out how to get down that mountain. And now it's all about preservation and distribution. So some of the skill sets used in accumulation, some of the tools, maybe even some of the advisors you used in that world, now we need to think about it from a different perspective. And maybe we need to rethink some of the tools, strategies, or even advisors that we utilize to make sure this money lasts as long as you do. And there's really 2 major foundational pieces as it relates to moving into retirement that everyone needs to really nail. And you kind of only have one chance at getting this right. And those 2 pieces are your income plan and your legal entity plan or your estate plan. The reason why we talk about the legal entity, whether it's a trust or will, that's the legal structure that a lot of your retirement and what you leave as a legacy, that's kind of your rule book. So you need to create your own rule book. And then the second piece of that is that income plan. That's really the foundation. That's going to give you the peace of mind to know that you can retire in the first place, is having a well-developed income plan. And that's important. That's something that we don't see a lot of people doing. Where if you go to a lot of these investment advisors or broker dealers, they'll talk about getting your rate of return and that type of thing, but they're not going to map out a true income plan. And that's what happens when you're working with a true holistic advisor, where we're focusing on income, investments, tax, healthcare, and legacy to put together a comprehensive plan versus just going to one of these vendors who give where you can log on and buy some mutual funds or someone sells you some stocks and bonds or put together a portfolio. Like, that's great, but that's just a piece of the puzzle. And really, what offers a lot of peace of mind and comfort and clarity and confidence to a lot of people as they move into retirement, it's not necessarily that investment plan, it's really that income plan. So how am I going to draw on my assets in retirement? And then the second piece is, okay, now that we know how we're going to structure these in terms of time horizons, how should we have each of these pieces invested, right? And that's really what we're talking about in terms of the bucket plan. So when we're talking about the bucket plan, what we're talking about is allocating these assets in such a way that we're managing time horizons. So the first bucket, which I talked about, is your now bucket. And this is money that's going to get you through the next year. That's the time horizon. And that really should be just sitting at the bank or in cash, okay? Anything more than that probably should not be sitting at the bank or in cash. You probably should have that invested, whether it's geared towards liquidity and growth with no guarantees of safety, so you invest it in the market, or do we look at gearing that investment to safety and growth, but we have to manage the time horizons and sacrifice a little bit of liquidity. And that's where we're looking when we're talking about putting together an investment plan. So that income plan is really what drives the investment plan, because we need to allocate these assets, these investments in such a way that if we do have an income gap and we need to draw on these assets, that's going to help us determine how we should invest those assets because of a lot of the risks that we have as we move into retirement. Now we need to be much more concerned about market volatility because we don't have as much time to make up money if we lose that money. And really the big risk now is sequence of return risks, where if all of a sudden the market goes down as you're drawing on these assets, it can have a devastating effect on the rest of your retirement. So that's why in terms of structuring your assets, we like to look at time horizons and this concept of bucket planning, of having a now bucket, which is the next year, a soon bucket, which might be from year 1 to 5 or 1 to 10, and then a later bucket. And so that soon bucket, that's geared towards your income needs over the next, say, 5 to 10 years. A lot of times that should be invested maybe more conservatively than the money that's geared towards your later bucket, which is more towards growth and legacy and long-term care. So as part of our income planning, we're trying to map out how are we going to structure your investments and how are we going to create income, taking a look at your Social Security, your pension if you have one, and drawing down on your assets so that at least the next 5 to 10 years of your income, we know exactly where that money is coming from. And the money that we've allocated to this shouldn't just be sitting in checking and savings because you're missing out on growth. But instead, what we do is we look to investments that are safe, so protected from the sequence of return risk, but can create some income for you and still have growth. And yeah, all of those things are possible. And then that frees us up so that the rest of your money can be geared towards that later bucket of money, which is more geared towards growth. So we're more willing to take risks because we don't think we're going to need that money over the next, say, 10 years or 5 to 10 years. That money can be geared towards legacy. So money that we don't think we're going to necessarily need while we're alive, and maybe we want to leverage that money for the next generation. And then maybe this is money allocated to long-term care as well. So if this is money that we don't necessarily need for retirement income, then that frees us up to maybe look at other things, whether it's creating a legacy or leveraging this money for long-term care. So it's a very simple and straightforward concept. And I like to start there, big picture, with a lot of my clients in terms of income planning. Now, understand, we have all the sophisticated software and running the numbers behind it, but it's just a simple idea where we sit in our conference room or sit on a Zoom and we can just whiteboard this out of, all right, we have all these different accounts. How might we allocate these big picture? And then once we get some confidence and clarity and comfort with an overall plan, then we can run the hard numbers and talk about the tools and everything behind it, what specific investments. So it is a nice process to understand how to marry the income plan and investment plan as we're moving into retirement. Because understand, while we're working, it's pretty straightforward. Just accumulate as much wealth as possible. But as we move into retirement, now we need to figure out, okay, how are we going to cover our expenses? Okay, which assets should we draw on? And this is where the concept of time horizons and breaking things into different buckets like now, soon, and later makes a lot of sense. And again, I wrote the preface for the book called The Bucket Plan, talking about protecting and growing your assets for a worry-free retirement. A colleague of mine wrote that, Jason Smith, and we have the foreword from, I think, Wall Street Journal called Ed Slott, America's IRA Expert. So there's a lot of knowledge in this book, and I'd love to send you a free copy of it. All you have to do is give our office a call at 844-885-4200. Leave your name, address, email, and phone number, and we will mail a copy out to you as long as we still have copies available. Again, it's The Bucket Plan, Protecting and Growing Your Assets for a Worry-Free Retirement. And it outlines some of the concepts that I talked about. And in the book, we talk about, in Chapter 1, the 3 big risks or dangers that you face in retirement right off the bat. There's multiple risks, but first one is market risk, where if the market goes down right as we're looking at retiring, then we're going to be in a much worse position, right? We don't want another 2008 to happen where we saw a lot of those 401ks turn into 201ks, right? And the second big risk is interest rate risk. And this is what we're experiencing right now, where bonds are just severely underperforming. Like, it's great in terms of your mortgage, but in terms of bonds or CDs, your interest rate you're getting on those fixed accounts, it's horrible. So that 60-40 portfolio might not be the most optimized portfolio. And then the third big risk is sequence return risk. So this is looking at the idea of, okay, as I move into retirement, now I have an income gap. How am I going to cover that income gap in such a way to make sure that I'm not pulling from assets or accounts that are going down in value as I'm trying to do this, right? And so that's where we look at structuring your investments to support that income plan. And then in Chapter 2, what we get into is the actual philosophy behind this, of the different time horizons. So the idea is that we're buying a time horizon and we can invest the rest. So we have our now bucket of money to cover the next year's worth of income. And then we have a soon bucket that's invested maybe more conservatively and geared towards income for the next 5 to 10 years. And then we have that later bucket where we get into trying to maximize growth for the investments, maybe looking at leaving a legacy, maybe looking at long-term care planning. Okay, so that's kind of the concept behind it. And some things that we do is we look at creating net worth statements. We look at how much income you have, and we take a look at whether you have an income gap. And then we take a look at how much risk are you willing to take on in your portfolio. So those are all things that we do as part of our holistic retirement and legacy blueprint process. And we think this idea of the bucket plan is an innovative way to really simplify income planning because there's a lot of different approaches. There's a lot of different strategies. There's that 60-40 investment strategy where we're taking out 4% relying on dividends, right? But again, dividends are one of those things that they're not guaranteed. They don't give you necessarily the best peace of mind, because what happens if the value goes down or they're not shooting off the dividends? Plus, from a tax perspective, it's not necessarily the most efficient from a tax perspective either. So there's different strategies as it relates to income planning. And again, income planning fits into that holistic approach of looking at building a retirement and legacy blueprint, of looking at income, investments, tax planning, healthcare planning, and legacy planning. And if you're not fully confident in all of those areas, then give our office a call. And what we'll do is we'll have a visit, whether that visit is in person, face-to-face, or that visit is over a phone call or a Zoom meeting, where really it's just about you asking questions of me, I ask questions of you, we figure out where you're at, we figure out where you want to go, and we figure out if we're a good fit to help you get there. And if that's something you're interested in, give our office a call at 844-885-4200, and we can schedule just that initial visit. As long as you mention that you heard this on the radio show, we won't charge you anything for that initial visit. It's really just a get to know you meeting where I figure out where you're at and I figure out where you want to go. And I'll try to give you some strategies on the call or on the Zoom or face-to-face to help you get there. And then you can decide whether you want our assistance or not. But again, if you are interested in that, or you want us to send you a free copy of that bucket plan book while we still have copies available, just give our office a call at 844-885-4200, or feel free to visit us on the web at castlewealthlegal.com. And if you say, you know what, Chris, this has been a great show, I'm looking for something a little more interactive, then what we have for you is a weekly webinar every Wednesday at 1 o'clock. And you might not be available for it, but I still suggest you register. You'll be notified. And then also, we always record these and they go up on our YouTube channel as well. But what we do on these weekly wisdom webinars is I just answer questions that people have submitted, either via email or while I'm live on the webinar. Where we talk about income planning strategies. We talk about investment strategies. We talk about tax planning. This last one, we talked about this unique opportunity based on where estate taxes are in the Trump Tax Cuts and Jobs Act and how they might be repealed, and how Bernie Sanders just proposed lowering that estate tax even further, and how there's things that you need to do if you have an estate tax issue to minimize estate taxes before those changes in law happen, which could happen as soon as next year. So again, like there's certain things that you have to take advantage of now because this window of opportunity, especially from a tax perspective, is closing. We talked about family inheritance trusts and how we can move money out of your estate now so that it's not calculated in that estate tax exemption amount that's going to drop as soon as Biden or Bernie Sanders gets their way. And that's just one of the things that we cover on a weekly basis on that Wisdom webinar, where I just log in, answer your questions. I have a whiteboard. We're drawing things out. We're kind of doing things on the fly. Last time, I think we had 40 plus people on it. So a lot of people find value. I do invite you to register. All you have to do is go to our website, castlewealthlegal.com. There'll be a place to click over and you can register for one of our weekly Wisdom webinars. And you can also go to our YouTube channel that has a lot of our past webinars if you want to get a flavor for what we're talking about. So, okay. So again, this week we talked about creating that income plan. And a lot of it is figuring out what is that income gap if we're going to have one in retirement, and then creating a preservation and distribution plan based on your assets to cover whatever that income gap is. Now, you might be listening and saying, you know what, I don't even have an income gap. And that's great. Like I have clients who maybe they're veterans and they're receiving the VA benefit. Just the other day, I was working with a family. Husband, 100% disabled, so he's getting $3,200 a month from the VA, plus each of them are also getting their Social Security. And so they don't necessarily have an income gap. And first of all, I saluted him and thanked him for his service. But in his situation, there wasn't an income gap. So that was less of a concern. So now we're more focused on, managing the investments for their retirement, but also what are we leaving as a legacy to the kids. So every situation is a little bit different. I'm not saying everyone has an income gap, but that's really what we need to start with is understand that, okay, if you do move into retirement, will there be an income gap and how do we cover that? If there's not, that's great. But if there is, we need to address that. And typically, that's one of the first things that we address as part of our retirement and legacy blueprint process, along with creating that legal entity. And we want to create that legal structure that's going to give us the rules for retirement and legacy. And then we want to create that income plan to make sure that we know that we can retire in the first place. And then the other pieces of the puzzle kind of fall into place. The investment plan, the tax plan, and the healthcare plan once we put together that income and that legal entity plan. So hopefully this has been helpful this week. If you want a copy of that bucket plan book, we'll send you a free copy. Give our office a call at 844-885-4200. If you want to see how this applies to you, give our office a call. Mention that you listen to the radio show, and we'll get you scheduled. Make it a great week. Take care. Bye-bye.
Learn more about Chris Berry and how he can help your family by visiting online at thechrisberryshow.com. That's thechrisberryshow.com. You can also call Chris Berry at 810-355-2584. That's 810-355-2584. This program content reflects the opinions of Chris Berry and his guests, not Castle Wealth Group or Advisors Excel, and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be used or construed as investment or legal advice, or a recommendation regarding the purchase or sale of any security, or to follow any legal or tax strategy. There's no guarantee that the strategist's statements, opinions, or forecasts provided herein will prove to be correct. Past performance is not a guarantee of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. All investing involves risk, including the potential for loss of principal. There's no guarantee that any investment plan or strategy will be successful. We recommend that you consult with a professional dedicated to your needs. This program is furnished by Chris Berry and Castle Wealth Group.